and welcome to Investors Hangout. This weekly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, with Akshaya Tritiya around the corner, many of us are prepping up to buy some more gold. The yellow metal carries a lot of traditional and cultural value for most of us. But how good is gold as an investment, and what are the different ways to invest in gold? You will get answers to all these questions and much more in this episode.
People trust gold simply because it has a long history. Modern financial systems, stocks, bonds, stock market, everything is 100-year-old or 200-year-old. But this is something which has been there for centuries. Then it is one asset which is a concentrated, portable. So you can actually have a worthwhile thing. Keep it in your pocket and travel. It is also liquid. If you want to sell it, you can. And now it has been liquefied even more. Very easy credit available against gold. So we have gold finance company which has come into being, and they are big ones. Their only collateral is gold, and they are able to lend you as much as you want to with a reasonable margin against gold. So that actually liquefies gold. So variety of things: history, tradition, that is also a very big thing, because Indian girls historically have not inherited the family's wealth. So on their wedding, they are given gold simply because that's the way the girls are being given a part of the wealth. So that is the case. Even though now in the we have a modern legal framework which enables girls to have an entitlement there, but tradition carries on. Also, this concentrated portable wealth, this was demonstrated around the time of partition. That was a big event, and people were migrating from here to Pakistan and from Pakistan to India. And the big difference, somebody who had physical assets and somebody who had gold. So if you could carry gold back, it made all the difference. Gold might have some characteristic. Gold has a history, tradition, convention, but as a great investment, the way people are getting excited, is it so? I really wonder it has retained its charm. Gold has been a good store of value, but is it a very high performance investment and compared to other alternatives which investors have? Maybe 50 years back, 60 years back, there was another case for gold, or maybe 30 years back as well, because market was not democratized. You could not buy stocks, bonds, or the way you can buy things today. No longer. Now if you have an app, and if you have a smartphone, and if you have Aadhaar, and if you have online bank, which most people have, the whole world is accessible to you. You can invest wherever you want to. So let's look at the numbers. If somebody would have invested in 1981, when gold, the 10-gram gold was worth 1800 rupees, based on today's prices, which is 52,200. So it's a big appreciation, 1800 rupees to 52,000. It has gone up by 29 times. So very impressive. It has been a store of value, and it has been able to preserve a reasonable value. But look at what has happened to Sensex. Sensex in 1981 was at 173, and that has gone up to 58,569. This is big. This is 338 times, and I'm talking of these little over 40 years. So this is real long term. 338 times in Sensex. And I'm talking of Sensex, of which 50% of the companies over the period these 30-40 years, half of the Sensex companies have disappeared. Hindustan Motors was part of Sensex. So, if you look at GE Shipping, it is no longer part of Sensex. Of course, that company exists. So despite high mortality, despite big upheavals in the market, despite big regulatory changes which led to many companies disappearing, despite that, Sensex is up 338 times as compared to 29 times for gold. Let's look at the last 30 years, or little over 30 years. 1991, the gold, 10-gram gold was 3,466 rupees. That has gone up by 15 times. During the same period, when the Sensex was at 1,168 points, in 1991, it has gone up by 50 times. So this is also quite significant. 50 times and 15 times. If you would have invested in 2001, when gold was 10 gram gold was for 4,300, this has gone up by 12 times based on today's gold prices. For Sensex, it is up 16 times. So longer the period, I think, the margin grows. But, look at the last 12 years or 13 years. If you would have invested in 2011 and gold was 10 gram gold was worth 26,400 rupees. So this price has doubled. It is, at 52,000 two times. And during the period, Sensex has gone up by 3 times. Sensex was at 19,445 points in 2011, beginning of 2011. So if you look at all these time period, 10 year, 20 year, 30 year, 40 year, the market has done substantially better than gold. And gold has been able to, preserve its value. I really don't know whether it has been able to preserve its value against inflation generally. I hope that the return from gold is little over inflation, but the market is beating it by a very wide margin. Gold has become more volatile. It was not this volatile about 20 years back. But ever since the financialization of gold happened, earlier people used to buy gold and keep it in the locker. And it was primarily in the form of jewelry. And selling your jewelry was, a very embarrassing thing unless you are in real difficulty. You will not sell your jewelry. So that was the case. People used to buy gold and keep it and maybe keep for a lifetime and keep it for generations. No longer. Now it has emerged as an investment vehicle. So the character of gold has changed ever since this financialization happened. Because today people can buy gold ETFs, gold funds, and earlier people used to buy jewelry, keep it in the locker and keep it for a lifetime, or keep it for, it used to be in the locker for generations. The holding remained. No longer. Now it is also being bought to be sold. And we have seen some great, crisis, financial crisis. The market in general has become more volatile. Because we are living in a more connected world. Something happens anywhere and it has a bearing. And whenever we see a big crisis anywhere, it snowballs into something which also affects our market. Whenever we have seen a big crisis in the equity market, in the bond market, gold actually then becomes very attractive. It is fancied. It actually turns out to be a safe haven when there is crisis all around. When we see the doomsday, then the gold is the only thing which is shining. 2 occasions which I can remember. The global financial crisis of 2008, that was the time when banks were collapsing in America. And it was extending to the whole world. Different market in different regions were also struggling. And that is when gold did exceedingly well. Gold not only actually preserved its value, because a lot of investors were chasing gold, that is why it actually went up. It went up quite dramatically, very impressively. Likewise, when we saw this pandemic, the beginning of it, and everybody thought once again that the world is coming to an end. It was a huge surprise. It was a big surprise. It was not expected. So when we are faced with a surprise of an unprecedented kind, gold shines, because that is something where people still have faith. People generally have this understanding that gold generally goes up. But look at these numbers, there are so many occasions when gold goes down by 10%, 15%. Look at these declines. So many investors don't have this sense that they also go down in value. They do. And they do very well when there is absolute lack of confidence in the financial markets. So it can well be, it's an uncorrelated asset. If you have a lot of equity, a lot of debt, you should have a little bit of gold. One should have gold for the very reason why Indians have historically bought, that it is a form of jewelry. It's a valuable jewelry. It can be cast into money, and it's a meaningful scale of money. And you enjoy it till you have it. And every couple of years you can also go back and get the design changed, or it is considered as the artwork. So that is one thing. It's a valuable jewelry which you enjoy till you have it. Then comes, there are different forms available. Today you can have a gold ETF, you can have a gold fund which invests in gold ETF. And then the third option which has come into being, which is sovereign gold bonds. So there is a difference. The gold ETF tracks the price of gold, and it's a reasonably efficient way. You want to buy 5 lakh rupees worth of gold ETF, you can buy it in 10 minutes when the markets are open, and it will be lying in your demat account. You can sell it as and when you want to. That may not be true with the gold bars, coins, or even jewelry. You can sell them, but it will come with some great deal of transaction costs, the making charges and other things. And you also don't have to worry about the storage. If you have too much of gold jewelry or go physical gold, then you have to make sure that you are able to keep it, preserve it well, so that it's not stolen or it does not really present a risk to you. But then managing gold ETF, it costs money. When you buy the gold ETF, the general cost can range between 25 basis point to 0.5%. So whatever be the price, whatever be the appreciation of gold, your return will be 25 basis point, 1/4% to 0.5% less compared to that. And then you have to buy it the way you buy stocks. You go to the stock market, you need a demat account, you place buy order with limit or whatever be the market, and then you buy it. Gold fund is simpler. You don't need to go to a stockbroker. You can buy it the way you buy a mutual fund, and you buy it based on that day's NAV, which is one NAV. Because in gold ETF, the market will be open and you can buy it anytime, and during the day itself, the price can change many times. Gold funds are a simpler way as compared to gold ETF, and gold funds are nothing complex. You buy the gold fund the way you buy a mutual fund, and gold fund in turn buys gold ETF. So even there, the expense is not very high. Little more than gold ETF. So there are two levels of expenses. Gold ETF has a cost, and gold fund has a cost because it is enabling you to invest in the gold ETF without going to a stockbroker. Sovereign gold bonds, these are bonds issued by Government of India. So they're absolutely safe. The promise here is that you buy these bonds at 100 rupee. These bonds have a tenure, maturity of 8 years. So you hold it for 8 years. Your investment will appreciate exactly in line with the prices of gold. So if gold is at 100 rupees today and after 8 years it becomes 300, this price will change by as much. Your 100 rupee investment in sovereign gold bonds will become 300. Not only that, you will also get a 2.5% interest every year. So government is strongly encouraging you to buy these bonds. When you buy gold, government discourages that because you buy the physical gold and you keep it in the locker. It is not a productive asset. When you buy these gold bonds, government is taking a risk on the gold prices, but the money is becoming productive. It is getting into productive economic activity as compared to gold, which when you buy it, it lies in the locker. All the capital gains is also tax exempt. And during this 8 years, if you want to realize it, if you want to sell it and have the cash, you can sell it in the market. So all other forms of gold ownership or gold holding, they cost money. They have an expense ratio, or you have to preserve it, or there's a making charge, or this is something where you earn little more than gold, and then all the good gains can as well be tax-free.
Well, with that, it's a wrap. Keep watching this space for more information, and if you like the show, do subscribe to our YouTube channel. Take care. Bye for now.